the way we've tried to organize this particular very, very interesting session is we've got a couple of capital providers, investors, and we've got a couple of policymakers. And we're going to try and see if we can get them to give us very specific answers and be prescriptive. The questions that I'm going to ask are not going to generate just some very broad answers. I'm going to try and push you to come up with very specific answers, right? Let's start with artificial intelligence. And my question is in two parts. First, I'll start with the capital providers because I think they'll be quite brave in their answers, right? Quite prescriptive, quite bold. So E, what in your view is one big opportunity that capital providers might be willing to bet on with AI in Africa?
We're heavily investing in talent, specifically talent that knows how to work well with AI. And when you think about the ultimate repercussions of that, particularly when you think about inclusive finance, the reality of what that means is that we're now training analysts that know how to stop fraud. We're now analysts that know how to use AI to identify potentially harmful actors in our financial systems. We're now using AI to train, our analysts on how to identify different demographic profiles of customers. So for us, we're really going to deeply invest in that. Second thing is language. For the most part, most of inclusive finance has been in English, right? You don't see many Kinyarwanda apps or Hausa apps or Yoruba apps. And it's been a big challenge in inclusive finance because we end up talking to the same crowd over and over again. And that's one of the reasons why Cash in, Cash out is perhaps the only truly inclusive financial application that has been generated over the last 2 decades. Now, with AI, and specifically by investing in AI translation models that take into account local language, we started with a pilot on using the Bible to take words out of the Bible and basically train AI to be able to translate into local languages. If governments can invest more in ensuring that the AI models, language learning models, are also inclusive of local languages, there is an opportunity to radically transform that sector so that when applications are designed straight to local languages, right? Giving the sort of information that people have. So for example, when you look at lending, one of the biggest scourges of financial inclusion has been what I call the rubber lending class, which you have this epidemic of apps that are throwing huge chunks of our population into the depths of debt. And we should have AI basically work with policymakers to say, look, if somebody has a debt burden across the system of, $5,000 and their income is $100, it stops today. No matter how much money you want to make, you just can't do it. And yeah, we can make the rule, but it's a different thing if we can actually stop things in their tracks. So those are the 3 areas of opportunity.
Okay, got it. Arjuna, if you had $100 to invest in AI in Africa, where would you do that?
E has solved all of my infrastructure problems with the AI, so I'm going to give you an application.
Yeah, on the top of that.
Given we're at the Inclusive FinTech Forum, I really worry about the toll that financial vulnerability and financial stress takes on households and small businesses across the continent. For those of us that have the luxury of having a personal financial manager, we don't worry about money. It's intuitive, it's invisible to us. We lead our everyday lives. So can we build that personal financial manager for every single household in Africa at a fraction of the cost that I pay sitting in San Francisco, that makes money invisible and makes all the little trade-offs and all the little choices that these people are making day in and day out that just sucks the energy out from the rest of their life? if I'm $10 short or I'm 10 shillings short, do I pay my tuition for the kids? Do I pay my phone bill? Or do I pay my electricity on a prepaid? Can we just optimize all of that with the smartest personal financial manager that acts in the background so people can live their everyday lives? That's where my $100 is going. I'm just waiting for the entrepreneur that's building this and the regulator that says, go for it.
Okay, so you've solved the infrastructure problem where you're investing in talent and in looking at regionalization or regional languages being translated into some common languages, potentially is English. You're talking about you want to build something on the top, which is a personal finance manager, which in the more developed world, generally it's something which is quite par for the course. Let's talk with you, Esselina. From a policymaker's perspective, how are you thinking about AI right now?
It seems to me that first should be a policy regarding the training of people to use to have skills on that one. So I'm thinking in policy in the side of education, in the side of creating those people that really understand the artificial intelligence and all the components. But as we are in the financial inclusion forum for FinTechs, for me, it's coming another angle, which is dealing with the financial regulator. That first, I do think that we need to understand that new technology in order to regulate, in order to put a policy that allow the usage for the benefit of financial inclusion in terms of artificial intelligence with all those components. If you are talking in terms of machine learning, if you think that with artificial intelligence, we can improve the efficiency in the way that the service and the product and the financial sector are delivered to the citizen, then I think there is here a huge opportunity. But we do have another risk that I'm seeing, or a risk that I'm seeing is related with ethics. What ethics are we having in using those technology? For me, it's very important to have that component of ethics because in somehow it's going to be linked with the risk. We cannot use those technology without thinking on the risks that are related with it. So if I can summarize, talents, so the education policymaker, they need to be aware about what is coming in this 40th generation of technology. The financial regulators and the policymakers have to see how we can use those technology to improve financial inclusion, and then we have to also to think on the risks that are embedded with those technology.
Understood. We were at the Capital Meets Policy Dialogue back in November in Singapore, and we had a question around the speed with which policymakers are able to follow when capital's gone in. A lot of tens of billions of dollars have been invested, value has been created in the company. 5-7 years later, some policy comes which comes and slam dunks that entire value that was created, and that's not good. One of the comments from a significant regulator who was on the panel, she said that, you know, for us policymakers, whether we do or we don't, we are damned either ways. You know, whether we come out with it too fast or too little or too much, we're going to have people who are going to say this was not done right. So I don't absolutely envy the role policymakers have to play. Let me ask Béata here, given your, you know, past role as Trade and Industry Minister and now as CEO for the BK Group, you know, now you're sort of straddling both sides. From your perspective, what is it that policymakers need to do to make sure that the opportunity that AI presents is capitalized fully?
I would advise that the policymakers look at putting in place a regulatory framework which supports an ethical use of big data. The capital providers, innovators will keep pushing as much as possible. But look at the big data being put in place. I think data location, data dignity, data privacy are key elements the policymakers should have an eye on, and making sure that they create a progressive, a dynamic approach to have that kind of framework, protecting the ethical use of big data. Otherwise, innovation comes first, policymakers come enabling, facilitating, and protecting.
Okay. So again, you're echoing the need for ethics in the whole process. Richard, what is your comment from as a banker, as an investor?
The root of it is in the data ethics piece, but AI, not dissimilar to FinTech before it, has become a catch-all phrase that means something and nothing at the same time. You know, so how artificial intelligence is deployed is whether it's generative, to speak to my earlier colleague, or whether it is very specific natural language processing. It's incredibly important across all of those verticals. I think first and foremost, to go back to the earlier question of where does the $100 go? I think to me, there's two parts to that. I think first and foremost, it's building compliance, KYC, AML to speak banker's language, compliance infrastructure that is free from bias and prejudice in a way that builds that ethical framework from the ground up. Because we have somewhat of a, if we drop off of that edge without doing that first, both as policymakers and businesses, then the speed of change of AI that everybody's worried about at the moment starts to mean that that bias and that prejudice becomes scaled and unstoppable and hard-baked. So I think the macro answer to that question is it needs to be in the data ethics piece fundamentally. And I think drilling down into that, into a specific point, I think the ability of artificial intelligence to empower the agricultural sector across the continent, whether that's in food security or whether that's in using artificial intelligence to be able to analyze crop differences through seasons, using artificial intelligence in quite a non-techie way, I think that can have real meaningful change, because all of these things need to stream in some ways into bigger macro challenges like climate and other things. So they're the two parts of my answer.
Got it. I'm going to switch gears and move to capital markets. And it's something that broadly across Africa, they're considered to be quite shallow still. And there is a need to improve liquidity in the markets. There is a need for an opportunity for the bigger grown-up organizations, startups, and Flutterwave, for example, is a great example of that, having a way to exit out and get the return that capital providers like Arjuna have made. So let me ask the two of you. Arjuna, let me start with you. What should Africa do? Is there one thing that they can do which, in your opinion, can help improve the liquidity in the markets, the shallowness that they currently are trying to improve upon?
Thanks, Naveen. Let me take a very specific FinTech investor, early stage investor view of this. There are two big constraints I would focus on. One is the lack of local currency debt. How do you securitize? How do you create structures that allow for local currency debt to flow to FinTechs, to other startups, to small businesses? So much of that capital is coming either from DFIs or internationals, and it's all hard currency, and it's really hard to make those business models work. The second thing I would say, and I think Honorable Tiam started to allude to this, in this current environment, international investors are pulling back from the continent. As an early stage investor, my biggest risk factor, amongst a lot of risk, is who's going to fund the next round for that company. Where's follow-on capital going to come from? And for that, we need depth in local venture markets and local private equity markets. And I would push to see what the asset allocations of every single insurance company and pension fund on the continent is, how much of that is going into private investments, alternative investments, venture funds. It's abysmally low. And you don't get that flywheel of markets and capital moving if you don't solve those problems. That's my perspective. I'd love to get to the answer where I've now built the company and it's going public and I need depth in the public market. I'm not there yet. I'm still solving these problems on the way to that, Naveen.
Yeah, no, in fact, there was a dialogue last year where somebody mentioned that the US Pensions Act back in 1979 was the first time when the pension money was allowed to be invested into startups, and that created incentives and liquidity that otherwise was not available. So the point you're touching upon is probably already borne fruit in another market, and it needs to be brought in here. E, you want to share something?
You started to share the context already, right? Which is U.S. venture capital is the product, direct product. Venture capital in America really started in 1972. Didn't really take off until 1979. And if there's one policy that made that possible, it was just that one policy.
Yeah.
But I think it's important to acknowledge the progress that has already been made. The truth of the matter is a lot of the challenges that we have today are challenges of what I call market translation. So for example, our investors, our international investors, logically put certain constraints on us when we began. You have to incorporate in the US, which is where we incorporated. You have to maintain, obviously, this specific kind of structure. And for them, success is NASDAQ. However, what we've realized from having IPO'd a number of companies on NASDAQ is that NASDAQ doesn't really like African companies, right? They don't want to see us. They don't want to invest in us. They invent scandals for us. Meanwhile, their companies get off lightly on the same things, right? They exaggerate the negatives. So startup CEOs don't want to go to NASDAQ no more, right? And our markets are excited about us. Our local markets want to invest because they see the product, they know the impact every day. And, markets like Nigeria are ready to take startups public. The stock market is begging for the transactions. However, when you take it to the board meeting with Uncle Arjuna at the board meeting, he's like, that wasn't the outcome I, signed up for. I don't think So there's going to need to be another kind of dialogue between us and the American investors to say, look, guys, we don't have to IPO everything, but you know what? Let's pay you a dividend by virtue of taking 30% of our local subsidiary on the market. Because not only are you creating financial risk for yourself, you're creating political risk for us, right? You cannot have a company that's 40% of our central switch domiciled in the US. The central bank is powerless to regulate that company for national security interests. So there has to be, that is the floor level conversation where we all come to the same page and say, look, guys, we love you. Thank you for giving us the milk when our markets weren't particularly friendly. But now we've gotten to this point, let's have a conversation. But once you've done that, then you have to answer the question of capital allocation. And especially because the proof points and the returns profiles are now there. Before they weren't, so it was reckless, because don't forget, when we talk about pension funds, we're talking about teachers' pensions and people who, everyday people. We can't be reckless with those meager resources. But now we can answer the question. We have a cadre of emerging managers that are delivering on returns. So I think we can start to have those questions become a practical part of the conversation, and enable pensions, particularly in many African countries, to allocate just a little bit. Just to give you a sense of where we are versus where we need to be. In Nigeria, up until 2020, it was illegal for banks to invest in fintech companies.
Okay.
That was just 2 years ago. Nobody has actually done it yet. Very few banks have done it. However, with better analysis, with more managers on the market, we're not far away from the outcome where a bank or a group of banks decides to set up a fintech fund so that they can actually invest. So I think we're getting there. But I think the first step, even when that happens, we still must answer what I call the domiciliation question. Nobody wants capital flight. Everybody wants to control the companies in their domain. And so our international investors have to get a bit more sophisticated about how they think about and govern subsidiaries of the businesses under the US umbrella.
Got it. Richard, do you want to share a perspective on that? We were talking about it.
Yes, I think ultimately, I think I'll come at this with a slightly different angle. I don't. It's both policy driven and private sector driven, but there needs to be this thinking where, in a regulatory sense, and this is what you're alluding to. There's, and this happens in Europe and in the rest of the world. It's not just an on-continent issue here. It's the innovation that is needed. There's a skepticism from public sector. The financial capital providers want to be providing capital. They can't price the risk correctly. They see, and particularly that's true when you're looking from Europe and the US downstream. And I think the other side of that is there's an element of there's two parts to this. There needs to be the removal of the cultural bias where Europe and America is low risk, Africa, Latin America is high risk. You know, that needs to fundamentally change. And so the liquidity issue can be policy driven, but I think it's also philosophically driven and trying to get away from a point where Europe, America is low risk and here is a higher risk, which is fundamentally not the case. And I think the way to do that, then to speak again about something that I put in my first comment, is getting to a point where we truly understand the risk profile and the risk metrics in these territories, Africa, Latin America, to a lesser degree Southeast Asia, where we look at it through a common lens rather than us and them lens, which is something that I fundamentally see as a Euro-American centric problem.
Got it. Béata, you have a perspective on how we can consider, or what are the ideas that can help improve liquidity?
Many of the markets are illiquid. Putting apart Johannesburg and the Egyptian or Casablanca markets, but usually most of them are illiquid. And for the continent, if there's one thing I would just bring on the table, would be to push or to support setting up electronic trading platforms for countries in Africa which don't have, but still for those who already have electronic platforms to be able to trade equity, fixed income, derivative products. I think it's crucial because that transparency is needed. That clarity of information, being able to predict, is crucial. And I think looking at the way mobiles have been penetrating the continent, it's a must. It's a must. The other element, I think, which also is needed, is to link some stock markets, those which are quite liquid, to the less liquid markets, so that you have more listing companies, you have more transactions, you have more liquidity. The cost of transaction is quite expensive. But being able to move from one market to the other, depending on other parameters, let's say there's a political risk in that specific country, and the capital provider can move to another one next to it because of those linkages, would bring more confidence, more comfort, and in the same sense, having it electronic would also facilitate to predict the activities and at the end having more liquidity onto the market.
Yeah, I read somewhere recently that there is an order routing system that's been placed by 7 country stock markets within Africa, who are trying to see at least if there is some way to accumulate all the orders and provide larger scale for companies or traders to actually trade in. So that's pretty impressive. I want to move to an important topic, which is on talent. And I think the previous discussion was deep on the need for, I think Tajan himself said that is very important. What in your view, when you're trying to solve for that talent topic?
I think the biggest challenge that we face on the talent front is scale. And when you have a scale problem is essentially a systems problem. And oftentimes we are, and I say this as somebody who perhaps started this trend, so I'm guilty. We've built programmatic interventions that are just in time. So we have miseducated a lot of young people up until the ages of 24 or 23. Then at that point, we say, come to Andela, we'll fix everything that's wrong with your life in 1 year. And then we take the most talented ones who manage to do it over to the US, right? And that is our idea of a fantastic talent intervention. It doesn't really work for the continent.
Locally.
It makes us a lot of money,
Yeah.
but it doesn't work for the continent, right? We need to start thinking systematically about it. And I think the baseline of systematic thinking around talent is for governments to understand, first and foremost, that an investment in your education system produces returns in tax, right? An investment in education produces a return in your future tax base, especially because of the internet. So when we take that systems issue, when you take that point of view, it changes how we think about the investment. So all of a sudden, $1 billion in your education system that gives you the upside of $3 billion, $4 billion. I can speak for Andela, where, you know, $15,000 over the lifetime, $15,000 investment basically results in probably $150,000, $180,000 over the lifetime of an Andela engineer. And that is the math that I think our governments are missing. But imagine that being done at scale. And so when you take that view, the next thing you realize is we're not starting early enough. So we cannot build interventions that prepare a workforce for the digital economy and try and teach in 2 years what other countries are teaching their kids from year 7. We can't compete if that's the path. So digital literacy has to become almost as important, if not even more important, than basic literacy, than numeracy and basic literacy.
Understood. Sorry, please continue.
Yeah, no, I just wanted to say, and finally, we have to become much more sophisticated about the, I don't like to use this word, but I have to because that's the context most people understand, brain drain conversation. Mm-hmm. So today, we produce talent, but we leak the best talent. And so that compounds our scale problem because we're not producing talent at enough scale. But if we produce 100,000 software engineers, 80,000 of them are working outside the continent because that's the only viable employment opportunity. There are three things we have to do now. Mm-hmm. I think the first thing we must do is we have to have a conversation with those countries around where the taxes of those children, of that talent is going. It is not right that we educate in our system, right? The kids go abroad and they keep the entire tax amount. They should give us back 10% or 20% of it at the minimum, right? I think we should get 50, but I'm willing to be reasonable. Yeah, the tax amount, yeah, I think you should get a chunk of it because they weren't educated in your system. We invested, right? Second of all, we have to create more talent in our countries than we supply to the rest of the world. So I don't know I don't know what that means, but one of the biggest challenges for companies who want to do this in, say, a country like Nigeria is we don't have large-scale infrastructure for us to employ talent at scale. We don't have any campus that can take 1,000 engineers in Nigeria. So even if you create 100,000 jobs, there's nowhere to keep those engineers. So naturally, what happens is the talent dissipates to where that infrastructure actually exists. And the third thing, and maybe the most important thing, and I'll stop here, is governments must be our anchor clients. Mm-hmm. And not just, I'm not saying give us contracts. We don't actually want contracts. But when you think about the talent that we're producing and the digital transformation imperatives of African governments, it makes no sense that you spend so much money training talent, and then you turn around and give a contract to Accenture, who's going to hire the talent. You're just round-tripping.
Yeah.
So
you're
just hire them directly. You paid.
Yeah, you're really talking about retention of talent after you've invested in them, keeping them within the country, within the continent. Arjuna, you've been meaning to speak something on this.
No, Naveen, I'll stick to my very ground-up view, right? I've been investing in EdTech and FinTech in Africa for 15 years before those were even words. First, I want to reframe the conversation and the question. It's not a lack of talent, it's how, you said this, a full third of software engineers on the continent are self-taught. So it's not lack of talent, it's not lack of smarts, and it's not lack of initiative. It's a lack of systems and structures that unlock that talent and allow it to live to its full potential. To do that, I think we need to rethink what secondary and post-secondary education is. I think the biggest systemic challenge is we don't have enough trained teachers on the continent. And that's not a quick fix, that's a generational fix. Without that, how do we rethink what it means to unlock potential? And it means rethinking what it means to be an educational institution, what it means to be a college. You can't say you need to have 10 PhDs on staff to teach these kids, because there are only 20 PhDs, and that puts the cost of delivering education to be unsustainably high. You can't stick to the notion that a university should have a library. Today, the library is Wikipedia and ChatGPT. You can't stick to the idea that a university needs to have a computer lab. Every kid today is on a laptop. They're using their phone as a computer lab, right? So how do we fundamentally rethink what it means to deliver quality education to an individual? That's policy, that's frameworks, that's regulation, and it's enabling innovation to thrive, to actually unlock all this potential, which we know is there. And we need to just remove the barrier and not have them be forced to self-teach themselves, like you said. And that's a full third.
Yeah.
That's...
No, in fact, the point that MD Ravi was making earlier, which is, the infrastructure role, to provide that infrastructure is a government role. And Aselina, you've been wanting to say something clearly about this topic.
Without a good education system, starting from grade 1 until the university, we will not succeed. So in terms of talent, beside what my colleagues here at the panel said, I'm thinking that we are in the era that the agility that those people with talents have to be in the market is a big issue, a big component that we need when we train people, how agile I am to adapt and to rechange, because things are changing dramatically. And we need to prepare people that can cope with those change. So the other component for me is the infrastructure. I can have that lab on my phone or on my computer if the national infrastructure is in place. Before we were talking on lab, because the infrastructure was not there. So there is a need also to invest in the infrastructure in order to allow that education system, in order to allow the building of talents and people with skill. I like the idea of taxation. And I want to put another component when it's coming to liquidity regarding taxation, which is in somehow linked with the taxation of digital service that we're providing. In many countries like mine, we're not yet making taxation of digital service as such, particularly when it's coming from abroad. How do we make the taxation? So there are other new areas that we need to bring in the discussion, so that can also contribute for liquidity. I will stop talking a little bit about the role. We've been talking about the role of policymaker, regulator, investor, and the investee. But there is another component, the one that we call facilitators, the one that can help to facilitate that component of market change. And I'm talking of institutions like FSD in different countries that are supporting either policymaker, the provider, in order to smoothly moving to a deep financial inclusion in Africa. In particular, today, as we're talking on financial inclusion, it will not be able without that component of facilitator in the market that is also needed.
Yeah, that sort of facilitator, I'm sure many of you may have seen, Sal Khan from Khan Academy actually believes that artificial intelligence is going to give a tutor to every underprivileged or young emerging economy population via a laptop. And so they're not going to need tutors at all. And that potentially over a 3-5 year period is an opportunity, again, from an investor point of view, again, from policy making infrastructure. Can internet be available at good speeds and devices provided on the top of which businesses like Khan Academy build and provide all of that learning capability, so the self-taught guy actually learns even faster and more can learn. I do want to talk about policy fragmentation, and Arjuna, we spoke about this earlier, and it's a bane that you worry about. So the idea really is that if you have small markets where there isn't enough population scale available, but they've built a good product and they want to take it out to a next market, but policies in that market are not similar to the originating market, the scalability of that solution gets limited, which means investors are not really attracted to investing because it's only scalable to the extent of the home country. What is it that can be done, that should be done, on improving policy alignment across willing countries, let's call it? I was earlier talking about maybe is there a need for an EU-light policy harmonization program where 5, 7, 10, 15 countries agree that yes, there are some things that we must harmonize our policies around so that innovation and capital can nurture and grow off of each other. So, Béata, any comments you want to make on that?
It's quite complex because externally you might have countries not included who want to join. We have to manage it. You might have countries within that region who don't want to embrace that policy or that agreement. And those elements have to be deeply analyzed because it will definitely be impacting the implementation of the policy. We're talking about policies, harmonized policies or policies of collaboration or agreements, but still we have behind domestic laws, domestic regulations. And I think it's where the complexity comes in, because between enforcing a law, a domestic law, and enforcing a policy collaboration, there is a big gap in between. But I strongly believe that that is the path. That's the path. You talked about the EU-light, but I think about the AFCFTA as well, where the agreement is in place and now at the stage of implementing. But one element I think I would highlight is to put in place a flexible dispute settlement mechanism. Mm-hmm. Because beyond the policies and the agreements, it's a progressive, it's a dynamic process. So it keeps having changes for each and every country. For people to get engaged, for capital providers to join and to be attracted, they need to also have some clarity on when it comes to a dispute, when it comes to predictability of any element people are not agreeing on. So I think it's important to have a flexible, agile dispute settlement mechanism, to have it transparent enough, to have it efficient, so that beside working on the policies to get them more harmonized, keeping in mind the domestic laws and regulations in place, when it comes to some disagreement, predictability is there. Transparency of how the mechanism need to be put in place is there. And it's not a small thing. You look at all the dispute settlements with WTO, with other regions. It's something where we have to be flexible, agile enough. It has a lot to do with policymakers, with consultation, but also giving a flow to the operators, to the capital providers.
Got it. Arjuna, one of the topics we discussed was around clarity of policy and things like data sovereignty, data localization, cloud. you're investing in many countries around in Africa. Are there sparks of real role models that we can potentially point to and say they are doing it really well, or you're not seeing that anywhere right now?
We've started in Rwanda. It took us 6 hours to incorporate. You've got $1 million in the bank, and this is your very real choice. Your international investors are telling you, you need to show certain scale in Rwanda, and you need to show me that this is a regionally scalable business, because if you go from Rwanda to Kenya, Tanzania, and Uganda, you're at 200 million people. Then you go, okay, I've developed all this amazing IP in Rwanda. I'm just creating an operating entity in Tanzania and in Kenya. We need to hire an army of accountants and lawyers to figure out the transfer pricing and the tax authority, and it's not even the same in each of these countries. And you're sitting there as a board member, an investor going, okay, I can take this money and invest in engineering and new customer services and new products, or I can pay PwC and an army of lawyers to get one more license. So we can harmonize at the policy level, we can harmonize at the central bank to central bank level, but until we get into the guts of the system and the revenue authorities talk to each other, and the reporting requirements talk to each other. The governor here talked about SupTech, supervisory technology. Yes, if I start in Rwanda, I press a button, I submit. I go to the next country that hasn't adopted supervisory tech, and I've got to have my entire engineering team come up with a new reporting structure that the other country wants. Yeah. Right? So we need to start thinking at the real ground level of what we need to do to make this work, because the potential is there, the scalability is there, but it is just so much friction to overcome. And that's what I'm constantly thinking about as an investor. Right? And that's what's keeping CEOs up at night. How do I scale? How do I build a platform that cuts across markets? How do I get to that next level?
Yeah, I mean, that's one side of it. There was a conversation I was in with an ambassador of one African countries back in Singapore, and she said to me, but why do we all see Africa as one? She said, we are not one. We are multiple countries, multiple cultures, multiple maturity, multiple stages of evolution. So why does everyone want Africa to be one? And I don't know what the answer to that is, or if that's the right question, but we somehow always implicitly assume that Africa should be one. You want to make a comment, Richard?
I'd like to add to that, sitting here as someone whose country voluntarily voted for Brexit. Policy alignment is a good thing, and it's something that we should be trying to embrace, and it does reduce friction, and it does create a whole bunch of opportunity. It needs to be considered, though, through a lens of both geopolitics, geostrategy, social realities. We need to celebrate our commonalities, but also be very aware of our differences. And you look at Africa, sort of the drives of SADC, common but different than in East Africa, for example. And again, to speak to your point, in West Africa even, these things are not. A drive for commonality is a benefit, but what we're starting to see in the West, for want of a better phrase, is so much of that happening. There's now pushback. The rise of sort of levels of nationalism, say Brexit and various things like that, and some other challenges in the US that are quite front of press these days. So I think it's embracing policy symbiosis, but through a cultural and society-driven lens, I think.
I do think that before we go to the harmonization at a continent level, there is a need to have harmonization in country.
Okay.
Because you do
across
have
agencies.
Yeah, you do have sometimes policy that in countries they are not concurrent for the same objective.
Yeah.
So I think the first step is harmonization in country. And as my colleague here, Rashid, was saying, in Africa we do have some regions that are organized, and you can go to the harmonization at that level, and we need to identify harmonization what and for what.
Yeah.
And if we identify exactly where we need to have harmonization, then we can make the life of the investees that are coming for a specific region more facilitated.
More simple, yeah.
Because even sometimes, even in country, they are having some
Yeah, absolutely.
so harmonization for me first, it should be
in the context of artificial intelligence. There was active dialogue which said there is going to be regulatory arbitrage because some countries are going to be light or gray on policies on AI, whereas Europe's going to be black and white and clear, and innovation will go towards where it's not clear so that it can flourish. But what you're talking about, regulatory arbitrage within the country, across agencies, within departments, that sits and does not get solved and is not helpful at all. I agree. You want to make the point?
So, I mean, as someone who's run multiple companies that have scaled into different markets, and I want to speak from the perspective of actually an operator, I think the challenge is a two-step challenge. Of course, what is unsaid is that governments and the politics of governance in many of our countries are not particularly the most encouraging of, foreign companies per se within the country. So naturally, there is a political pushback when a big Nigerian company shows up, and it might overwhelm the market, especially if it's small. So this is what creates a lot of the friction, if we're speaking very plainly what the issue is. The solution, in my opinion, is for all of us to opt in through international financial centers, right? So what I would say, for example, if we want to do like a licensed passport, we make a licensed passport available in international financial centers, and we can partner with local companies from that international financial center to serve the market. But that I have a passport that's recognized, for example, in KIFC means that Nairobi International Finance Center, Nigerian International Finance Center, whatever, actually gives me that pass. And I think that's easier because we all opt in and we all have a dynamic market to serve in the IFC environment. That gives me the data to know if I want to make the investment to become local, because that's often the challenge. I actually don't even know if I want to be in your country.
Yeah.
At the same time, it also gives me the country some level of comfort that it's not just going to be overwhelmed by a disinterested international player that isn't willing to fully invest in that market, which is often the challenge.
Yeah.
So I think we have to have a balanced conversation around this element.
Okay, I have one yes or no question, and I know the answer will be yes, but I wish I had more time for it. But digital IDs in Africa should be a top 3 government priority, or #1 government priority. Let's just go around the table before we close.
From my point of view, we will not have a digital transformation if we don't have well-organized the identification of the citizens. So for me,
so it's a #1 priority, not a top 3, but #1?
Within the top 3, because the government have other priority, but between the digital transformation, it's #1.
No, of course, we've seen in India with the Aadhaar tech stack, where, over the last 8-9 years, they've got 1.5 billion people on one system. FDI is now coming in. People are building around that core infrastructure. It's all flourishing. So that's the reason I asked that question. E, what is your view? Top 3, #1.
So I have a perhaps slightly more controversial.
So our time is up, so we have to be quick.
Okay, I don't think it's bigger priority than talent or infrastructure.
Okay.
Because if you have digital identity and nobody knows what to do with it, you just have data abuse, which is what's happening in a lot of our countries. People's data is just being proliferated on the internet without any practical use case. So first of all, we got to build digital infrastructure, digital talent, and digital governance. Then identity is just one element of it.
Okay. Arjuna.
Yeah, it's yes and, right? It's digital public infrastructure, what India has done, what Brazil has done.
Yeah.
There are multiple layers to it, of which digital ID is one component, then absolutely.
Got it. Richard, you agree?
Yes, I do. Is it a public policy? Is it private sector as we move into Web3, or a public-private partnership? I'm not sure, but yes, but one of those 3 things.
Okay, got it. Béata, what's your view?
What if I say no?
Say again?
What if I say no?
Oh, well, everyone wants to know why.
I think
You are saying no?
it's very important
Okay.
to have digital IDs. But when I look at, let's say, the African continent, and you have very few people, we have the highest percentage of people don't have identities, legal identities. And then you still have lower rate of internet connectivity. I think we have to look at social exclusion risks there, as well as for those marginalized communities, to be sure they're not going to be left behind when it comes to public services they can have access to. But then definitely infrastructure comes first. And should you have said from top 3 to top 5, I would say yes. But for top 3,
No.
I would say top 5.
Okay.
Because I think infrastructure is crucial. Connectivity to be having it in place is crucial. It attracts digital, it attracts capital providers, but in the same time, there are elements to come first before, and then we go deeply into the digital IDs. When you have the infrastructure in place, and we see that it's possible, there are a lot of things comes on its own, but still, as a policy, I think the social exclusion has to be also paid attention to.
Excellent. On that very bold view, let's call it a day and thank the panel for their time.